During the Trump presidency, the 30-year fixed mortgage rate averaged around 3.7%, hitting a historic low of 2.65% in Jan 2021. Yet, largely due to economic conditions set in motion during that era, rates more than doubled to nearly 7% just 2 years later, the fastest sustained jump in over 40 years. The cost of borrowing money to buy a home seemed to be on a one-way path downward. By January 2021, as the Trump administration was ending, the average rate for a 30-year fixed mortgage hit an astonishing historic low. It fell to just 2.65%, according to data from Freddie Mac. This figure represented the lowest point in more than 50 years of record-keeping. For millions of American families, it made home ownership or refinancing seem more attainable than ever. It was a period of exceptionally cheap money during the final year of Donald Trump's presidency. This era of ultra-low rates, however, proved to be fleeting. The subsequent 2 years brought a dramatic and painful reversal. By late 2022 and into early 2026, those same mortgage rates routinely hovered near 7%. The whiplash effect on the housing market was profound, sidelining countless prospective buyers and reshaping the financial calculations for millions of households. While rates were low during his term, the long-term impact of fiscal stimulus and deregulation created a complex legacy. This essay will explain the chain of events, starting with policies enacted during the Trump years, that contributed to this sharp swing. In 2020, the economy reeled from the shock of COVID-19, and low rates were a key part of the emergency response. Today, the economy has absorbed the aftershocks of that response, and higher rates are a direct consequence. Understanding this transition is crucial for grasping the current state of housing affordability. It is about a series of policy decisions with far-reaching and, in some cases, delayed consequences. The seeds of today's 7% mortgages were sown in the environment that produced 2.65% mortgages. To understand how we arrived here, we must connect the dots. The shift from a 3% mortgage rate to a 7% rate is not just an abstract economic statistic. It has a profound impact on the finances of American families. Consider a home priced at $400,000 with a standard 30-year fixed-rate mortgage. The difference between early 2021 and today is staggering. At a 3% interest rate, the monthly principal and interest on $400,000 would be approximately $1,686. This was the reality at the peak of the cheap money era. Now fast forward to today with a 7% interest rate. The monthly payment for the exact same loan skyrockets to about $2,661. That is an increase of nearly $1,000 every month. Over 30 years, the borrower at 7% pays hundreds of thousands more in total interest. This cost shock chills both buyers and sellers. For buyers, higher rates slash purchasing power. The home affordable at 3% may be out of reach at 7%. Families trade down in size or location, or abandon the search. First-time buyers without equity are hit hardest. For sellers, a powerful lock-in effect keeps low-rate owners in place. Moving forfeits a sub-3% loan for a much higher one. Fewer listings constrict supply, pushing prices up for the limited inventory available. The Trump administration began with a goal of boosting growth. A core part of this strategy was making borrowing and investment favorable. From 2017 to 2020, mortgage rates averaged around 3.7%. This environment was fostered by policy choices, deregulation in the financial sector, and public efforts to influence the Federal Reserve to keep rates low. President Trump frequently framed low rates as a competitive tool. Short-term benefits included rock-bottom mortgage rates, but pressures built beneath the surface. The approach had two primary prongs. First, easing post-2008 rules, especially for smaller and mid-sized banks, to free lending. More lending can stimulate activity, but it can also add risk and fuel housing demand. Second, fiscal policies injected significant sums, notably the 2017 tax cuts and later massive pandemic relief packages. These actions altered the flow of money and credit, In the short term, borrowers benefited. The government even considered buying mortgage bonds to push rates lower. But these interventions set the stage for a later reckoning. Aggressive demand stimulation helped inflation take hold as the economy recovered. Mortgage rates later spiked in reaction to those conditions. Tax cuts without offsetting spending cuts expanded deficits. More treasury supply can push up yields, the reference point for mortgage rates. Mortgage rates track long-term bonds, particularly the 10-year note. The crucial turning point arrived in March 2020 with the onset of COVID-19. The CARES Act, $2.2 trillion, was signed into law by President Donald Trump. Direct checks, enhanced unemployment, and forgivable small business loans followed. Its goal, prevent catastrophic collapse and bridge households and businesses. These measures stabilized a cratering economy, but the money injection dramatically boosted demand. Meanwhile, supply chains were constrained: lumber, microchips, and more. A textbook recipe for inflation. As reopening began, prices climbed at rates not seen in decades. A Federal Reserve Bank of San Francisco study estimated fiscal support raised core inflation by about 3 percentage points by late 2021. Stimulus continued under both the Trump and Biden administrations. Sustained fiscal support, plus the Fed near zero, supercharged the economy with cash. Analysts called it an inflation crisis. Rising inflation forced the Fed to act. That set the stage for the dramatic spike in mortgage rates. The same forces unleashed by emergency fiscal policy were those the Fed had to rein in. Policies to stimulate demand led to high inflation, which forced rate hikes, driving mortgage rates sharply higher. The result? A new crisis of housing affordability. This is the story of the cheap money era, followed by an inflation hangover. Presidents influence rates indirectly, not directly. Markets set mortgage rates, but fiscal policy shapes the environment they react to. Fiscal stimulus and deficits boosted demand and borrowing needs. Inflation surged, the Fed hiked, mortgage rates reset higher. Understanding this chain is essential to analyzing today's affordability crisis with clear eyes. The housing market is confusing. Subscribe to Your Money, your interest for visual breakdowns that make finance simple.